Hey everyone, welcome back to another episode. Trading with naked price action stands out as a powerful method because it helps you anticipate market moves by concentrating on the one element that truly matters, price. In this video, we've compiled some of the most effective price action patterns and methods we've discovered through years of hands-on trading experience, which have consistently proven to work. Today, I'm going to walk you through how to recognize these setups on the chart, explain the psychology that drives them, and show you how to apply them to make smart, data-driven trading decisions. As always, don't forget to hit the like button to support the channel, and subscribe if you're new here. Welcome back, and let's dive into the first price action signal, the inside bar confirmation. Picture a ranging market, where price has been moving sideways within a confined zone. Suddenly, price breaks out and closes above the resistance level, signaling that buyers have gained control over sellers and the market may now trend upward. But how do we confirm this breakout is genuine, and not just a false move or market manipulation? Because price can easily snap back into the range and resume moving lower. One way to confirm the breakout is by waiting for a pullback followed by a rejection, suggesting that the broken level will hold. The challenge, however, is that this pullback might never happen, and we risk missing a strong long entry setup. This is where the inside bar confirmation becomes useful. An inside bar is made up of two candlesticks. The first is known as the mother bar, which is wide and dominant, followed by a smaller candle that forms entirely within the range of the mother. This pattern signals market hesitation. In an upward trend, it shows that buyers are taking a pause. The second candle, usually a small red one, appears after a strong bullish move. In contrast, during a downward trend, it suggests that sellers are losing momentum, shown by a small green candle appearing after heavy selling. So how does this pattern help us evaluate whether a market structure breakout is reliable? When an inside bar appears following a market structure breakout, it represents a brief phase of uncertainty. If the price then breaks the pattern to the upside, it indicates that sellers attempted to drag the market back into the previous range, and failed. This serves as added confirmation that the breakout is legitimate and that there's a greater likelihood of continued upward momentum. For example, on the US 31-hour chart, the market rejected the same resistance zone twice. Eventually, price breaks through it and forms an inside bar pattern, signaling that sellers are again attempting to push it below. However, if the price breaks above the mother candle's high, it suggests that buyers have regained control, validating the breakout and increasing the probability of further upward movement. Now let's move on to the second price action signal, fakeouts. A fakeout, also known as a failed breakout, takes place when price breaches a key structure level but quickly reverses and falls back into the previous range. Picture an uptrend where the market pushes beyond a resistance zone. Typically, we'd expect this area to act as new support upon retest, leading to a bounce. But if price cuts straight through it without hesitation, this is known as a fakeout. It often reflects strong momentum building in the opposite direction and can be an early indication of a potential trend reversal. On the Bitcoin 15-minute chart, we recently saw a break below a support level. Naturally, we expect this zone to act as resistance and push price lower. However, when this resistance fails and price re-enters the previous range, it signals strong buying pressure, suggesting the potential for price to keep climbing. Shifting to the 1-hour chart, we notice the broader trend is bullish, as price has broken above a key structure. By combining the higher time frame trend direction with an entry trigger on the lower time frame, we can anticipate a bullish move. Over on the gold 15-minute chart, there's another example of a fake out. What makes this one notable is that it occurred after price tapped into a demand zone from the higher time frame. This gives us dual confirmation that the short-term bearish move has likely ended, pointing to a possible reversal. Still, always practice patience. If a setup doesn't meet your trading criteria, it's okay to skip it. Now, let's move to the next signal. But before we do, if you want to see more content like this, don't forget to show your support with a like and a comment. Number 3, double top and double bottom entry. This is a widely recognized M-shaped reversal setup often used by price action traders. A double top pattern forms when price fails to establish a new high, typically signaling issues like a loss in momentum, a shift in structure, or interaction with a major level on a higher time frame. The most cautious way to trade this setup is by waiting for a break of the neckline to confirm the reversal. However, entering after this break often requires a large stop loss, which isn't ideal. A more practical approach is to wait for price to return to the neckline and look for candlestick rejection patterns as an entry trigger. But this can also mean missing the trade if no clean candle setup appears. So here's our method for trading the double top and double bottom. We pair it with the 0.618 Fibonacci retracement level to refine our entry. After the neckline break, we apply the retracement tool, found under the IND Indicators tab, from the beginning to the end of the move, and set a sell limit exactly at the 0.618 retracement. Now, some of you have been asking in the comments, trade like Assad, how do we know where the move ends when drawing the retracement? The honest answer is, we don't always know. If price continues pushing, just update the retracement tool based on the latest swing. And if price hits your target before a pullback even happens, then it's better to skip the trade altogether. The same logic holds true in a bearish setup. Price rejects a zone twice and confirms the pattern by breaking above the neckline. We then apply the Fibonacci retracement tool and set our sell limit around the 0.618 retracement level. The stop loss should be positioned just below the swing low, and our take profit would be at the next significant market structure level. But here's a key insight: trading every double top or bottom that forms randomly in the middle of nowhere isn't a solid strategy. A better approach is to identify higher time frame key levels where price has shown multiple rejections, and then wait for double top or bottom formations in the lower time frame for confirmation. Looking at the EUR1 United States dollar hour chart, we can see a significant market level that has acted as both resistance and support multiple times. I'd wait for price to move into this supply zone before scouting for a double top formation to catch a potential short setup. Now if we zoom into the 5-minute chart, we observe that a double top has occurred, and price breaks below the neckline. We apply the retracement tool from the start to the end of this move and place a sell limit at the 0.618 level. Stop loss is set just above the swing high, and our target is the next nearby support zone, giving us a risk-to-reward ratio of over 1 to 2. That said, this setup isn't restricted to only one method. You can use additional price action confirmations to refine your entry, such as this long wick rejection candle. But the key takeaway is this: to build trust in your strategy and refine your edge, it's essential to backtest your setup across different pairs and scenarios. Shrinking candles describe a price action behavior where the size of the candle bodies progressively decreases as price approaches a supply or demand zone. In this chart example, we can see the price moved upward, touched a key resistance area, and then reversed. Pay close attention to how the candle bodies reduce in size while approaching this zone. The reasoning behind shrinking candles lies in the fading strength of buyers. Smaller candle bodies reflect weakening bullish momentum, indicating a reduced ability to push price forward. This serves as a subtle early warning that the bulls are losing grip, and a potential reversal could occur near that level. For better accuracy, this signal should ideally align with another reversal indication, like a doji or a candle showing a long upper wick rejection at the end. Keep in mind, this logic applies similarly in a bearish context as well. The momentum candlestick setup involves two back-to-back candles where the second one has a larger body than the first. This formation highlights strong momentum entering the market, hinting at a possible continuation in the same direction. It's important to note that the pattern is more reliable when the larger candle closes without an upper wick, which suggests buyers maintained control until the very end of that candle's life. Always view this as a stronger setup when it aligns with the prevailing market trend. Looking at the GBP 1 Japanese yen hour chart, we can clearly spot these momentum candlestick patterns. Observe how the price continues to climb after each of these formations appears. While this alone shouldn't be the basis for trade execution, combining it with other strategies can support smarter and more strategic trading decisions. 6. Rising and falling wedge patterns. A wedge is essentially a consolidation phase where price moves within a tightening structure marked by two converging trend lines. It reflects a temporary indecision in the market where buyers and sellers are both battling for control. The breakout direction from this structure helps us identify who's taken over, bulls or bears. When a falling wedge breaks to the upside during an uptrend, it's often a continuation signal. On the flip side, a rising wedge breaking down during a downtrend suggests bearish continuation. But here's the challenge: fakeouts are common. So, when should we enter? Here's how we approach this setup in a bullish scenario. First, wait for a break and close above the falling trend line and the last significant market structure. This double confirmation tells us that buyers have enough strength to push forward. Next, watch for price action signals near the breakout zone, like rejection wicks or reversal candles, to time your buy entry. Checkmark example, on the gold 1H chart, the higher time frame is clearly bearish. We see a wedge formation, a sign of consolidation. Then price breaks below both the wedge and previous support, confirming bearish control. Now, apply the Fibonacci tool and mark your sell order at the 0.618 retracement for a high probability entry. Another case is seen on the Bitcoin 1H chart, with a clean downtrend followed by a consolidation phase. Zooming into the 15-minute chart reveals a rising wedge. A breakout to the downside signals that sellers are back in charge, aligning with the broader bearish bias. 7. Combining high-quality confluences. The most reliable trades are those backed by multiple layers of confirmation. Let's dissect an ideal example where several technical elements align, creating a high-conviction opportunity. Brain price action breakdown. Clear downtrend. The market is consistently printing lower highs and lower lows, so we want to stick with the dominant momentum. Key structure level. A well-tested support, resistance zone that has rejected price multiple times. Respected trend line. Several touch points reinforcing the trend line as valid. Shrinking candle bodies. A loss of bullish momentum as price approaches resistance. Double top formation. A textbook reversal signal suggesting exhaustion. Long wick rejection. Candlesticks with long upper wicks right at the confluence area indicate strong selling interest. Bearish engulfing candle. A strong momentum candle showing that sellers have stepped in aggressively. Clipboard all signs point to a high-quality short setup. When you get this kind of layered confirmation, trend, structure, patterns, and candlestick behavior, it's a solid 5-star trade. The key takeaway: don't chase every pattern. Build the discipline to wait for high-quality setups and skip the weak ones. Final note: if you found this breakdown valuable, go ahead and hit that like button. It really helps. And if you're new here, don't forget to subscribe for more price action tips and strategy breakdowns. See you in the next one.